Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the pre-market webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Dimitri, myself, Market Chameleon are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. One last look at that disclaimer, and let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Great. And we're talking about charting option risk premium today, correct?
Yep.
All right.
So let me share my screen. And then what we'll do is go to an example, and we're going to look at a chart of option risk premium, and we'll discuss how to read the chart, how to change some of the parameters around, what type of insights it's given us. So let's first go to a symbol. I'm going to go to SPY ETF, and under the SPY ETF, you see a menu on the left-hand side. Click on volatility and then hit risk premium, and you will come to this page. I'm going to close this menu to expand our screen. And what this chart does is it looks for us, it scans the options markets and creates a chart of what the risk premium is for a particular option benchmark. So in this case, it defaults to a 30-day constant maturity. So you can see here at the money put option.
Hey, D, I apologize about that. Could you just go back one step how you got there from the landing page?
So click on the symbol, type in the symbol in the search box. And after you type in the symbol, on the left-hand side, you have a menu. Click on volatility, and then click on risk premium.
Thank you.
Yep. And close this menu. And so you'll land on this page, and you see by default you have this chart. And when we look at trying to put a value on options, lots of times you'll see reference implied volatility. In this case, what we do is try to put it in perspective of cost. So it's very hard to say, what's the cost of an option? We have an implied volatility of 11, 12, 50. So what is the relative cost of that option? And what has it been historically? So what this looks at is the cost of that premium. Okay, so when you have a put option, it has time premium, right? What is the cost of that time premium for 30 days? And this converts it to a percent. So you can see here, percent premium of what the cost is over the price of the stock. So if the option is $1 and the stock price is 100, well, that's like a 1% premium. Okay. So we do it on a relative basis. What's the cost of the option premium relative to where the stock price is? So if the option is $5 and the stock is $100, then it's 5% premium. Okay. So this kind of gives us a way to normalize and look at that cost over time. And here we see that at the money put for 30-day constant maturity is currently around, this is where we are right now, is 1.4% at a 1.4% premium. So for every $100 worth of stock you want to insure, it'll cost you $1.40, to protect it for 30 days. Think of it this way. Okay. And we could see how that premium has changed over time using this chart. So this dotted line over here, that's the average of all our observations in the last year. And we could see at this level currently, we're above the average. So it's 1.4% versus an average of 1.1%. Okay, now we got like a sense of, what that cost is and relative to historical average. And we could also see how that premium has changed and moved around over time, and how far away it got above and below the average. Right? So it's how much variability, how much it moves around. We see the high in the last year, the peaks and the lows, and we could kind of follow the trend. So that's a 30-day constant maturity put. And it's just quickly to put things in perspective. Now, what if we wanted to change the moneyness of it? So the moneyness of it is we don't have to just look at the money. There are out of the money options as well, right? There are puts that are out of the money, downside puts. There are calls that are out of the money, upside calls. So what if we wanted to chart those and keep the time frame at 30 days? So over here under premium, we could look at different options that we could select. Let's say we wanted to look at a put that's 5% out of the money. Okay, so that's minus 5% from the at the money put. Okay, so if we select that reload chart, now we get a different chart with a different premium. And what this lets us do is see what the premium is of a wing or an out of the money put with a 30-day constant maturity. Because you do have a skew there where sometimes out of the money put could start increasing faster than that the money or flatten out. So we want to see what does that 5% out of the money put look like. And think of it as like, you could see that it's cheaper, right? That one was 1.4%, but a 5% out of the money put is a 0.3% premium above the, stock price. And which makes sense because think of like an insurance policy. If you get an insurance on your car, the higher your deductible, the lower your premium because you're willing to take the risk. Let's say you have a $500 deductible, you have your insurance is one price, but if you take a $1,500 deductible, your insurance will be less because you're willing to take a bigger risk on. And that's how this works, because if you're buying it out of the money put with a lower strike, well, that means that you're taking a bigger risk, that you own a stock. If you're buying it for protection, stock goes up, down 1%, 2%, that put doesn't cover any of that move. So here we see it's at point.
We did have a question about premium. Rob is asking if the premium is high, then is it correct to assume that volatility is high? And if this is correct, to relate that high volatility to either buy or sell. So I guess he's saying if risk premium is high, is it then, and volatility is high, is it something you look to buy or sell is what he's asking.
So implied volatility is the risk, right? So if the premium in the options are going up, the implied volatility is going up, right? So the implied volatility of the option will be high according to the Black-Scholes model, right? As the premium goes up, you put that into Black-Scholes model, it implies a higher implied volatility. So that's that. So yes, it would be a different way of looking at the option. You could look at it from the Black-Scholes perspective in terms of implied volatility, or in this perspective, we're looking at it just as the premium, the time premium relative to the stock price. Okay, so it's a different way to look at that option. But here it's a little bit, easier to kind of, I think, put it in perspective of the cost, right, of the option. And it might be easier to even compare it, from, and I'll show you one option versus the other, right? So when you do a time spread, right, let's say you're doing a time spread, you're buying one option versus the other, it's hard to say, well, what's the cost of that time spread? You'd have to convert it to something that is more meaningful. So let's even do that as an example. Let's say we wanted to see what the cost of a time spread would be. So of course we could change this time frame to 60-day, 90-day, and 120-day. So let's first go back to the at the money. Okay, I'm going to go back to at the money option, and let's look at a 90-day time to maturity. Okay, so this is a 90-day constant maturity option. That's an at the money put. I'm going to reload that, and here we see that currently the cost is 2.3%. 2.3%. So for every $100, to ensure every $100 worth of SPY stock costs $2.30 for a 90-day option. Okay, so which is above the average, 1.8%. So let's say we're looking at a time spread and we're looking, well, what's the difference between a 90-day and let's say 30-day, right? And if we wanted to see what would that cost, because we know we're paying more for 90 days, right? If you're insuring yourself for a longer period of time, well, there's a higher cost to it. So what is the difference? What is the difference? Because we could buy 90-day option, sell 30-day option. That's time spread. What does that cost? And then what is that cost relative to history? Are we on the higher end, lower end, on the average? So let's do this at comparison. And here we have 30 days already selected and an at the money put, right? So we're going to say 90-day at the money put minus the 30-day at the money put. Let's reload that. So you can see here, 90-day at the money put minus 30-day at the money put. So the total cost is over here on 0.88% relative to the historical average of 0.72. So it's a little bit higher than the historical average, right? So we could see here. So this is letting us know that the term structure right now, the way it's set up, is that the longer dated options cost a little bit more relative to the shorter dated options than we had on average. And this is important because sometimes in the implied volatilities, you won't see that. You would have to go, because the vega of the shorter term option is much lower than the vega of the longer term option. But now we kind of see the difference, and we see what that looks like relative to historical averages, and where those historical averages, or where do we see those historicals, in the high and low end. So we're closer to the higher end than the lower end of the cost of that strategy. So it's a quick way to look at that, theoretical time spread. So keep in mind, the 90-day, 30-day at the money, we don't have an exact 90-day at the money option or an exact 30-day at the money option. So these are benchmarks based on a methodology and formula, if there was one. Okay, so similar to the VIX. The VIX, it's a methodology. But this is what in theory would look like. What if we wanted to do a diagonal? So diagonal is a little bit different because we have two different expirations, right? So we could keep it at a 90-day and a 30-day. So we have two different expirations, but a diagonal involves different strikes, right? So the moneyness, so that it doesn't have to be the same distance. Both of them don't have to be, at the money. One could be an at the money, one could be an out of the money. Or they could both be out of the money, but different distances away. So let's say we're looking at a 90-day option minus a 30-day option, but the 30-day option is, let's say it is 2% away, 2% out of the money. Okay. So what is the cost of that? So the cost of it should be higher because now we're selling, put that's a little bit further away. So that put should be, cheaper, right? It should cost less, but we're still looking at a 90-day out of the money. But let's see what the cost of that is. So we're going to reload that. And here we see that it's 1.52% relative to a historical average of 1.26. So that's on the higher end of the history, if we compare it to here. When we do a diagonal, you're kind of doing two things: a time spread, a term structure. You're looking at the skew of the term structure because the term structure moves around, and also you're looking at the skew of the different strikes distances away. So this one, you can see here, it's also on the higher end of the historical average.
Hey, D.
Yeah.
We have a question from Stefan about the term structure. He's asking, with the 90-day minus the 30-day at the money put being above average, does that imply a higher risk of a market drop over the next 3 months than average?
So it doesn't necessarily mean the directional. It is more of it's an elevated. You would say yes. It was an elevated Vega across the board. So it's costing you more in relative terms to insure a longer period of time. Okay. So it's the uncertainty has been, going. The uncertainty has increased along the term structure, along the curve. But that's also it'll probably be typical even if we have uncertainty in the shorter term. But that's what it is. It's going to cost you more to insure, to buy volatility, to buy premium on the longer term, even if you're financing it, with the shorter term.
Excellent. Thank you.
So those are a couple ways we could look at it, but we could do it at the same time on the upside. What if we wanted to look at let's say 30-day at the money call, and we wanted to sell an out of the money call further out, let's say 60 days, and we did an out of the money call. Okay, so you could think of it maybe in this term. A lot of people, when you do buy right, when you do a buy right, you're buying a stock and you're selling a call option against it. Maybe even a longer term. But instead of buying the stock, if you're thinking that the 60-day maturity is that option is the relative premium is high, you could just buy another call, maybe with a shorter term, if you're holding it for 30 days. The idea there is if the stock goes up, right? Let's say the stock goes up about that, the money. Well, you're going to own that. You're going to end up owning the stock, right? You're going to get exercise. You'll own the stock and you'll have that buy right after 30 days. If the stock goes down, well, this call that you bought will be worthless, but the call that you sold should also be worth less. But if the stock goes down a lot, you didn't own the stock, past that strike. So it's maybe a different way to look at, a buy rate strategy instead of just owning the stock. So let's see how that would look. So I'm going to reload. So you can see here the cost of that right now is 1.3% versus 1.9. Okay. Let's do, just to show you what an at the money would look like. So you see here with an at the money, buying a 30-day call, selling a 60-day, you're getting a credit, right? Because you're selling on the same strike an option that's higher premium. So that would be negative 0.8%. It's a credit. So it's kind of different ways to compare these options and observe the cost relative to its history. Another thing is, if we go down here, we created this table, and this table shows where the current cost is for each of these. So this is an at the money, call third. So you have 30 days, 60-day maturity, 90 and 120. You have calls on one side, puts on the other side. These are the current premiums. This is the change on a day. This is the 52-week average, the low and high, and the percentile, if it's elevated, subdued, or if it's moderate within range. So this table allows you to quickly see it, and you could see where all of them are kind of in the elevated range. But if you just wanted to have quick reference to see the average high low, let's say we were looking at the 120-day maturity, and we wanted to see a put option that's 5% out of the money. Well, the premium is 1.37%. It's down. It was down a little bit yesterday. The 52-week average is 90.96, so we're above that. But here's the range for last year, as low as 0.55%, as high as 2.38%. So you have that quick reference in this table. All right, well, so I'm going to stop there because I think we covered a lot regarding this page.
That was awesome, D. Another great webinar as always. I am going to leave the community with something different. I'm going to add something, see if I can add something to the stage. Someone sent us a interesting video that just came up that they took outside their house. So I'm going to share it. It's some beautiful cranes in Minnesota over the lakes leaving right now. Rob did have a question that popped in at the end. He said, this is a drill down for compare. He was asking about a screener. Is there do we have a screener that can screen for this sort of high vol option on particular stocks or multiple stocks? I don't know if that's something we can look at tomorrow.
Yeah, I don't think we have a screen, but I'll work on it. But I don't think we have a screener for this particular report.
All right. And with that, D, thank you. I'm going to remove you from the stage, remove myself, and we'll just end with some cranes over beautiful lakes in Minnesota. Thanks, Swami, for sharing this. I'm going to bring it up right now. There it is. Bye, everyone. Have a great day. Thanks, D.
Bye, Ron.